Hi everybody, it's me, Greg Manarino. How are you today? Alright my friends, so what is going on here? Well, for the past 2 days, we've seen the US dollar value plummet, and we've seen a market rally. What's going on here is several things, but something I've been speaking about for a very long time now. In fact, ever since we started hearing about this fiscal cliff nonsense, it's being priced into the market. And for those of you that understand how markets work, you realize what's going on here. What I mean by that is the market is anticipating some type of a fix or something. Now, the market always, and again, this is almost an absolute, gets ahead of itself. And what I mean by that is we can expect, in my opinion, a high probability that the market will respond negatively to whatever fix or band-aid solution is going to be offered. We may see an initial bump, but then we're going to see a sell-off. It always happens like this. And the reason why I'm talking about it now is because for those of you out there that understand how I like to trade, I usually take the opposite end, meaning if the market is bullish, I'm bearish. If the market is bearish, I'm bullish. So what I am doing, and what I want those of you out there that are traders to think about doing, is starting to position your portfolio in a way that you can capitalize on exactly that scenario. So let me just outline this. They're going to offer some type of a band-aid fix. We may see a little bump, and then we'll probably see a sell-off. If you're positioned correctly, you can capitalize on that. And then what will generally tend to happen is the market will overcorrect in the short term, and you can capitalize on the upside again. It's a game. Understand, this is a money game, and it's just out of control. Don't take your eye off the ball, though, people. When we're talking about the markets long term here, and I'm not talking about trading, the equity markets are incredibly overvalued based against unemployment, based against GDP. I've been over this many times before. And once the free market is allowed to do its job, we're going to see a correction across the board that is going to shock people. And I'm talking about commodities correcting to the upside. Gold and silver are going to skyrocket. Interest rates are going to spike. That's going to put pressure on the equity markets, which will sell off. That's how this is going to play out as we move forward, and fear in the market is going to drive these, again, to overcorrections on either end. And we can capitalize on all of this, and it's not that hard to do. This is what the professionals are doing, and this is what the central banks are doing, the investment banks. Understand what's happening now. And again, this is a concept I've been over many, many times. The Federal Reserve has been front running the markets. What I mean by that, again, is allowing their partners in crime to borrow money at next to nothing and speculate in the market. So we're seeing this bubble. It's a reinflating of the equities bubble. They're trying very hard to reinflate housing bubble. That's going to be much more difficult than equities because the Fed is offering negative returns on, for example, bonds, and they're crushing the dollar. So people and investors are looking for somewhere to put their cash so they don't get robbed in a literal sense. So they're being forced to get into the equities market. And right now we're seeing what I would say is a risk on trade. We see some cash coming out of the paper gold and the paper silver market, and this is awesome for those of us that are in the physical stuff, because these pullbacks are a godsend, and I've been over this. Again, keep your eye on the ball, meaning a currency collapse, people, of epic proportions is on the horizon, and you need to be betting against that debt. It's that simple. And by holding the metals, you're literally taking the short end of the trade. In my opinion, my